gold is the warning sign. We don't know where gold's going to top out or when, but I do think we're going to see a big financial reset. We could see miners rally potentially, 25% or so from where we are. A 25% move in GDX could be like a 50 or 100% move in an individual miner. I'm saying it's taking its first pause and breather, and then I think we're going to have another big push, a huge FOMO move where everyone chases it. It's going to be very exciting.
Chris Vermeulen, Chief Market Strategist for thetechnicaltraders.com. It's a true pleasure to host you on Palisades Gold Radio today.
Hey, thanks for having me. Pleasure.
Chris, excited to hit the ground running talking gold for a second. We've seen a sort of double top forming on an intraday chart at around $4,400 an ounce. And since then, quite a violent pullback. What are you seeing for gold right now?
Yeah, there's a lot of action in the gold space. If we look at my charts here, we've got a daily chart of gold really showing over the past more or less 2 years, it's just been up and to the right. I think the big thing right now is I believe we're getting closer to potentially one more big rally in the precious metals space, simply because I think we're in this getting close to a major financial reset. And we'll get into this, but gold and silver are warning us that something big and bad is coming. We just don't know what it is. And when we look at the recent price action, obviously we've seen gold really go parabolic. And if we look at the volume, on the volume side, this is telling us like people who are open to buying gold, who are open-minded to get into it, they're piling in. And really, we saw about 20 days ago a massive wave of FOMO. Of people they couldn't take it anymore. If they're not in gold, silver, or miners, they have to get in. And so we saw this FOMO move. And I talked about this as it was unfolding. And we got to get ready for some sharp pullback because the market is going to try and buck out late comers temporarily. And I do think we're going to see gold and silver shoot a lot higher. But right now it's having a really nice correction. And in fact, believe it or not, it's a fairly controlled correction. When we have a momentum move where something goes kind of parabolic, and I guess I should just kind of go back one step. Let's just take a look at gold in this parabolic phase, because this is kind of how it plays off. If we go look back in the 70s, we saw this huge parabolic move to the upside. We did see a parabolic move going into 2008 markets, 2007, 2008 market top, which it looks dwarfed because price has gone higher. We see multiple of these waves, and usually these are usually near the end of gold and silver having a bit of a run, and they're going to have some correction. So a good view of this too, just before we jump into a little bit more detail, look at the chart of silver. Parabolic moves, generally what goes straight up when everybody who's open to investing in that moves in at the same time, usually these moves fizzle out. You could give this chart to a fifth grader and say, what do you think is going to happen next, right? And they're most likely going to say, it's going to go down. So this isn't generally really rocket science. It's just understanding cycles, human psychology. We've seen, everyone now people chase money. They chase returns. And so when things take off without them and they have a huge move and they feel like everybody's making money but them and they're missing out, they create this feeding frenzy because they just keep buying. They don't care what price they get into. So that's the phase we're in. The spike in gold and silver are telling us something is wrong. Something is likely going to break in the economy or globally, and we just need to be aware of that. So if we were to kind of look more so in the daily chart of gold, we've got this nice pattern I was just mentioning. It's actually a controlled pullback. Anybody who kind of bought right into this phase where the FOMO in the air was so thick you could cut it with a knife, a lot of people think it's out of control, it's put in a top, but this is actually a pullback. It's got a little bit of a bear flag. It's got another pullback. It's kind of made its three-wave move to the downside, an ABC correction. And it's the break of this little pivot low right through here usually creates a flush out. And gold usually wants to put a bottom in after this. It's this type of price action. Maybe we see gold pull back a little bit more, but this is actually a very healthy price. And usually we should see gold stabilize, and then I think we're going to see it skyrocket higher for another big push. As we get into some other charts, I can show kind of where I think we are in this major cycle. So I'm very bullish in metals still, and it's interesting because back 20 days ago, I was telling everyone, I think we're about to see a bit of a correction here. And now everybody seems to be really scared and they don't want to get back into gold and they've been scared out of it. And that's a good sign, because if people are scared and they've gotten out, usually that means gold's putting in a bottom. And so I think it's the same across the board for gold, silver, and miners. People have gone from they have to have it to now they're scared. They're scared out of it, a lot of people, and they're scared to get back into it. So this is a good sign. I think we're gold and silver carving out a bottom.
Interesting that no matter if you're talking about trading or long-term investing, you want to be contrarian to take the other side of the coin. Talking this gold bull market for a second, when I talk to fundamentalists or fundamental speculators, they're thinking this might be a really long-term bull market that we're in. It sounds like you're predicting one more move to the upside.
Yeah, I think we're going to have one more big push. I mean, the fundamental case for gold and silver have been bullish since the day I was born. I mean, I've been in this industry for 25 years and everybody's always talked about the dollar collapsing and gold and silver to the moon. So, I mean, I have learned a long time ago that it doesn't matter what the fundamentals are. Price is still going to do its own thing and they don't have to follow fundamentals. And back in 2000, I was buying some of these strongest stocks. They were literally having quarterly growth, the highest quarterly growth, quarter after quarter, and their share price still got cut in half, and then it would fall and get cut in half again because there was a bear market. We saw a big unwinding in the risk-on assets. So I've learned a long time ago that it doesn't matter what the fundamentals are. It's nice when the fundamentals support the technical, the actual price action, but you really do need to focus on price and not get sucked into the hype, into all these stories of the world collapsing and all of that stuff, because it's been going on since the day of dawn here, age dawn, and the world hasn't fallen apart and gold hasn't gone to 25,000 like people were talking, 20 years ago. So that's kind of the scenario to look at gold, is to just focus on the price action. And yes, the fundamentals and the stories and the big central banks buying gold, it's all a really bullish story, but the price charts still are the end result. Either people are buying it or they're selling it. And it doesn't matter why they're buying it. It's gold is going up because people want it, or it's going down because they're nervous. And every time we have a financial reset or there's a giant parabolic move in gold and silver, it's always for a different reason. There's always a different reason behind it, but price does the same thing. It goes up or down. It's being bought because they want it or sold because they don't. So, you can only take the news with a grain of salt here, because it's just, it's not going to really predict where a price is going to go all the time.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI. With equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold, Palisades offers investors powerful leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Chris, you made an incredibly interesting, at least to me, comparison recently in 2007, where we saw a big push into platinum, silver, and the likes as well. Perhaps you can walk us through that?
Yeah, so this is a really interesting comparison. The left chart is the 2007 stock market. This is the S&P 500, the candlestick chart. The yellow line is the price of gold. Now, both of them have been rallying for a couple of years together. And just like what we see on the right-hand side, we're seeing the stock market hit all-time highs. Gold has been rallying at the same time. When gold rallies, it's telling us that people don't trust the financial system. They don't trust the government. They don't trust the currencies. They're worried the stock market is going to collapse. Physical gold rallying is a warning sign that something big and global is about to happen. And so people want to get outside of the financial system and hold something with physical value. That's not just a bunch of ones and zeros on a computer that could, vaporize. So this comparison is really interesting, because if we were to, we had this consolidation in gold back in 2006, 2007, and it blew up and took off to the upside as the stock market hit all-time highs. And then we started to see a little bit of weakness in the S&P 500, and we saw gold start to pull back a little bit. Well, I kind of believe we're somewhere similar. We have gold having its first pullback. We've got a little bit of a pullback in equities markets. It's still grinding higher, but we had this consolidation in gold really over several months. It really kind of traded sideways here, trying to figure out what it's going to do. So I think we're very close. Now, if we were to just fast forward to what happened in 2007, the stock market started to run out of steam and started to head lower. And as money came out of the equities market, it was looking for where can it go to make money. And so money came out of stocks and it went into precious metal space. You can see the yellow line shooting higher as more so the stock market fell. And so I believe we're going to see that. I think we're kind of right now in this kind of phase, the first hiccup in gold right now on this chart. And I think we're going to see the stock market eventually struggle and start to pull back, and money is going to flow into precious metals. And money's always looking for a return. As I mentioned before, money's chasing return. So if the stock market's not working, it moves to a different asset class. And this is, typical. It's asset rotation. It's when people are looking for a return, they need to go somewhere else. And depending where they move tells us how they're thinking and feeling. So gold has been outperforming for a couple of years. That is telling us there's a lot going on underneath the hood of the markets, underneath the hood of the economy. People aren't trusting it and people are looking for safety. So the really cool thing here is if we were to just kind of look at this chart. So if we go back and look at these multiple layers, the next chart down are gold miners. And what's interesting here is right as the stock market and gold were kind of putting in a top, we saw gold miners come to life. People started to pile in, big volume there. We also saw silver come to life. We saw platinum and palladium come to life. And of course, as we matured, they all shot higher as more so the market was getting closer to collapsing. And eventually, the stock market did collapse. And if we look at that, we can see the stock market fell 55%. And the problem with a big bear market is it will naturally pull all these precious metals down with it to some regard, and some of them down 50, 60%. So if we were to fast forward to where we are kind of right now, we have the same scenario going on where everyone's piling into miners, into silver, into platinum and palladium. They've come to life. There's lots of volume. It feels like the crowded play. People have FOMO. They're chasing it after it's already had a multi-year run to the upside, and they're just now piling in, right? So this is the interesting scenario of what's unfolding. And when we look at it from one other layer, if we were to just kind of backtrack and compare these two windows here, if we look at the US dollar, I get this dollar to show up here, you can see the green line here is the US dollar index. Of course, everyone hated the dollar. They said it was going to collapse. It was, way down in value. Well, if we look at where we are today and we put the dollar on it, the dollar has also had a big sell-off and it's undervalued and people hate it and they think it's going to collapse. So when you strip away the news and the reasoning behind, or the potential reasoning behind things, the charts are all showing the same type of setup. People are fearful. They sense something big and bad is coming. They don't trust the dollar. They don't trust the government. And all this kind of signifies that we're getting close to a major topping phase. And you may have seen this. I've shared this chart before, but if we just go back and look at the cycles within the stock market, this blue cycle here is the stock market top. And typically we see precious metals come to life just before the stock market goes off a cliff. And so that is one of the big, this is a big warning sign that something big and global is lurking just around the corner. We just don't know what it is yet or when it's going to actually happen.
However, it sounds like when we look at that 2007 example, maybe perhaps the biggest move in precious metals is still ahead of us.
Yeah, I believe this big run here where we could see gold rally 15, 20, 30% is potentially just around the corner. This is really a multi-month pause or a multi-week pause potentially. Again, if we look at the charts and seasonality wise of gold, typically gold tops out in October, in the middle, early October. It sells off till kind of the end of November. So we've just seen this. Gold has started to pull back, and I would expect gold to struggle here for another 2 weeks or so. And then we go into the end of the year rally where gold could take off. And all this kind of aligns with what we've seen on the previous charts from 2007. So it's pretty exciting. I mean, I follow investor sentiment very closely. I've built tons of custom indicators to get a read on what people are thinking, feeling, and what they're doing with their money. And understanding the psychology of retail investors is huge. And we've kind of gone from a FOMO stage really in the gold space here if I just go back to the chart of gold or silver, we've gone from this FOMO phase about 2.5 weeks ago to now people are actually nervous, and some of them actually don't want to get back in. They think gold's topped. So it's gone from like, you must have it, I need to have it, to I don't know if I want to own it anymore. And if we were to just kind of look back on this chart, I do believe if we went back to the 70s, this same chart pattern unfolded, and it actually shows 100% upside for gold from this point forward. So when we're in a bubble phase and we're in this type of scenario, we don't know where the top is. We can only kind of take it one leg at a time. And, we could use Fibonacci extensions here to get an idea of where this next move could be based on this rally that we've seen over the last several months and this pullback. Using a Fibonacci extension, which is one of my favorite tools. It's also one of the most accurate tools I know. It's telling us we should see gold run to 5,100 over the next potentially few months here. And percentage-wise, it's about a 30% move, which is actually what happened in 2007, 2008, just as the stock market topped. We saw gold run another about 30%. So, it's a different time, but the market, as they say, it rhymes, right? It's going to be similar, I think, in terms of what happened before. It doesn't matter what the news is causing it. Investors still go in waves of buying and selling, and the charts paint that picture.
And Chris, what do you think of the argument, of course, when we're talking about the 1970s or the 2000s, the world was a different place, social media wasn't a thing yet, the internet has connected people and made these moves faster. Should we see a compressed timeline, or is that argument not really in play?
Yeah, I think it's a good point. I think we could see a compressed timeline. I think things could happen quicker. It's tough to gauge, it really is, but there's no doubt information spreads a hell of a lot faster now. Yeah, I mean, it's impossible to predict the future or how something will unfold. I would naturally think it happens quicker. I think the markets can sell off. We have these crashes back, in the 80s and the May 2010 flash crash. The markets can still rally and fall just as quick as they used to. Back then, it was bigger spreads, fewer traders, but when they wanted to sell, price can fall just as fast. So I wouldn't particularly say it's going to be faster. I think the markets have a natural speed to it, and we just have to let things unfold and kind of ride that roller coaster, right, and play it out.
Understood. Before we talk about exciting topics like oil and gas, copper, uranium, so many other commodities, I would love to talk about your framework for a second. Really, what do you base your trades upon? What is the framework that you use to decide where a commodity or an asset class should go?
Yeah, so I use a strategy that I call asset revesting, which is focusing on reinvesting our capital into whichever asset is moving up and that has the least amount of risk. So more, for example, instead of diversifying and holding gold and stocks and bonds and whatever else you want to hold, the strategy that I do is like, which asset is moving up, which one is the most stable, is in an uptrend, we want to move to that. So it could be stocks, it could be bonds, it could be a currency, it could be cash, it could even be precious metals, depending on the whole strategy of what we're trading. So my whole strategy is focusing on, I just want to hold things going up in value. When the charts tell us that trend has come to an end, we step out of it, we move away, we liquidate, and we look for the next asset, and we just move our money into that. So we're always in something that is going up in value. It's a pretty straightforward strategy, and I like to look at it as I'm a surfer and I love the ocean, so I think analogy is look at the stock market like from a bull or bear market standpoint. When the tide is going up, you want to own equities or that asset class. When it's going down, all boats go down, so you want to get away from, for example, the stock market and move somewhere else or benefit from falling pricing. And when we zoom in as a short-term trader, if you're a surfer floating out in the ocean past where the waves break, what are they floating out there waiting for? They're waiting for a set of waves to roll in, a big set of waves. And the stock market, bonds, gold, silver, all these assets, they have about 5 to 12 sets of waves that roll through the markets every year. So we'll step back and wait in cash until we see a wave that shows from a technical standpoint, following price action, the trend is now turned up. There's a lot of power behind it based on our intermarket analysis. We can identify how strong or weak a trend is. And then we hop on and we ride and we surf that trend, that wave higher. And the nice thing about waiting and catching these big standout waves is that when they start to weaken, we can see that. And we can mentally prepare saying, okay, we need to start locking in some profits. We need to move our protective stop up. And we need to know that this is probably coming to an end soon. So we're not caught off guard. We don't panic. We don't, have to, when you're mentally prepared for something and you have a strategy in place, you just have to execute it. Easier said than done. Emotions want to naturally get in your way, even when you have a strong strategy. But the key is to understand what's happening and have a game plan to execute going forward. So that's what I focus on. I'm rule-driven, rules-based. I have strategies that adjust with the markets, and I just follow those.
Understood. And you mentioned the word risk there a couple of times. Of course, a very muddy term in the financial space. It means a lot of different things for a lot of different people. What does risk mean to you, Chris?
Yeah, so risk to me is more or less every time you put your money into the stock market, into bonds, into precious metals, I believe, and more so it is true, the market is trying to take your money. I mean, as an investor, it's like a zero-sum game. Like you're trying to, the only way you're making money is if you're pulling it from somebody else's pocket, right? So risk to me is the second you put your money into the stock market, it's at risk. And so all I want to do is literally stand back, wait for a wave to come in the market, and then we jump in, we catch that wave, and as soon as it's showing signs of weakness, we start trimming off our exposure, like locking in profits. And then when it rolls over, we move, we get out, and we wait in cash again. I consider being invested risky, and it carries risk. And so we only want to be in there when there's a strong uptrend or a strong downtrend, because we can profit from falling prices as well. But it's all about how can we make the fewest amount of trades every year, have the least amount of risk and volatility in our portfolio, and make the most money. And this strategy to me is as close to the holy grail as possible. It's a low volatility strategy. Even during the 2008 bear market, our strategy only had about less than a 6% drawdown. So it just goes to show it's very, very protective. It allows us to navigate market corrections and bear markets and COVID and the 2022 bear market and all of that stuff, simply because we follow price closely. We know when to get in, when to get out, and we navigate it. And that's risk management is the most important. Risk is almost the same as position management. You need to manage both of those. You can't be over positioned. A lot of people will put a huge position into something volatile because it has huge potential. And then when it backfires, they take a big hit to their account. So you need to understand position sizing, like allocation, and then you need to also know when to move in and out of that asset.
How important is market liquidity to you?
Well, I'm only trading more so the key markets, right? So we trade the U.S. stock indices, so it's pretty much as liquid as anything can be. And so it really is simple. We trade ETFs, which ETFs have big liquidity. And not only that, but they have market makers. An ETF has to fill your shares if you put an order in. So we don't have to worry about that. If you get into trading small and micro cap stocks, liquidity is a major issue. You can put a buy order in or a sell order in, and you can drive the price up or down very quickly. But because we're trading either the stock market as a whole, or trading the bond market, or a currency, those are like the biggest, the kind of three asset classes. We don't really move them because we just swiftly move in and out. We're like a blink and a quick order in there. So liquidity is not an issue. There's not as much liquidity in the market, I think, as there used to be, meaning if some selling does kick in, the markets can fall fairly quickly. But again, it doesn't affect our trading strategy so much.
Understood. Apologies. One of those muddy terms as well. I meant to ask regarding liquidity in the form of how much cash there is in the system being printed by, for example, the government, and how the capital flows through the markets, that type of liquidity.
Yeah, I mean, I'm not sure. I don't pay too much attention to the government liquidity. I mean, they're always printing money. I mean, yeah, it's not my side. I really focus on what assets, assets to hold, buy and sell, not so much how much is afloat. I mean, you look at those dials that show how much, debt the U.S. is in. It just is clocking up. I mean, I don't know how much liquidity is actually in the markets. I mean, we saw a couple of years ago, the venture capital market just vaporized. It went from everybody throwing money at everything to nobody wanted to invest in anything. And that's slowly picking back up, but mostly in the AI space. Everybody wants to be part of the AI, which is kind of also a warning that I think we're in this crowded trade in the markets. And it kind of brings up an interesting point. If we were to look at kind of the economic cycle of where we are, if we look down at the business cycle, which is this yellow cycle, typically right near the end of the stock market peak, we have this innovation and adaptation phase, which is something new comes in. In 2000, it was the tech bubble. Right now, it's the AI bubble. And AI stocks happen to be the biggest heavyweights. So even though the stock market really isn't that strong, a handful of stocks are dragging the markets up, making everybody think the markets are doing really well. And a good view of that is if we were to just take a look at SPYD. Now, this is the SP 500 large dividend stocks. And if we just look at them this year, while the stock market has been like raging higher, the dividend, investors who have that supposedly safe and smart position, which is dividend reinvesting and dividend positions, they're actually down 10% from the highs. And in the last couple of days, we've seen dividend stocks fall pretty much 4%, while the stock market rallied almost 4%. So you got to be very cautious. This market is not as healthy as you think. The Mag 7s, Nvidia, Google are dragging things up, yet investors who are just in the old generic buy and hold strategy and holding dividend stocks, they're actually struggling. They're nowhere near the highs unless they hold a bunch of these high-tech plays, separate to help juice up their portfolio.
You mentioned at the start of this interview a financial reset. Does this play into that weakness that you're predicting for the general stock market as a whole?
Yeah, I do think, gold is the warning sign. We don't know where gold's going to top out or when, but I do think we're going to see some bad news hit. I would think in the next quarter or so. It feels like we're on the cusp right now based on the money flowing into the precious metal space, the strength of FOMO and retail investors chasing money in that space now after it's kind of been rallying for a couple of years. It's telling us we're very close to the end. I do think we're going to have a big financial reset. When it happens, it's going to pull, I think, almost everything down. I think we'll see precious metals get hit fairly hard. And I think real estate, and we're going to see equities. So it's going to be a real battle. I think one of the plays that will probably do well will be the US dollar index. We tend to see when there's chaos, crisis, we tend to see the US dollar index rally, in a time when everything else is falling. So we'll just have to see how that unfolds. But I do believe we're getting into an economic reset of some sort.
And will this be only in the United States, or should we see contagion towards Europe, Asia, and other markets as well?
Yeah, that's a good question. I recently was showing all the different, country indices overlaid with the S&P 500, and pretty much when the S&P 500 is in a bear market, every other stock market is pulling back. Now, some of them might top out a few months early, some of them might not top out for a couple months after the US. But overall, the whole world is either generally growing or contracting. And gold is telling us that it's more of a global thing. It's not just like one sector. I mean, we have the AI space right now, but overall, gold is the global barometer. It's kind of like look at the world like a hive, like the hive mentality. Everybody's nervous. People all around the world are buying gold because they're all worried about their own country and the problems brewing. So I do think it's a global problem, and that's one of the reasons why gold is having this big rally.
Understood. And in this type of pullback scenario, of course, the capital needs to rotate into something. Might that something be precious metals miners? If we look at fundamentalists, they are saying that the companies are still incredibly cheap on a price to free cash flow basis. And this might be an interesting place to park your capital.
Yeah, I mean, I think miners can do fairly well. I do think if we do go into a reset, you probably don't want to hold them. But if we were to just look at, what happened back in 2007, there is quite a bit of upside potential. Like we're somewhere in this phase right here. We could see miners. This is the GDX rally potentially, 25% or so from where we are. And so that means if you have individual stocks, small caps and micro cap, gold miners, a 25% move in GDX could be like a 50 or 100% move in an individual miner. So we're still in a sweet spot. Precious metals, I think, is kind of at the halfway mark. I think this next push higher, if the market turns around, is going to be huge. And so this is, I'm not saying the precious metal space is done. I'm saying it's taking its first pause and breather. And then I think we're going to have another big push, a huge FOMO move where everyone chases it. And so there's some pretty good upside, I think, in miners still. And it's going to be very exciting. The next few months are going to be probably pretty wild.
What about the juniors, Chris? Is that something that's on your radar?
Yeah, I look at GDX kind of as a broad move, right? It's the same. Miners are miners. Just the small cap miners will move percentage wise more. If we take a look at the monthly chart again, when we start to look at the miners, you can really get to see the parabolic spike that we're having. Obviously, they're nowhere near where they were. From a fundamental standpoint, gold miners, silver miners are way undervalued, and they have been for quite a long time. And it's screaming right now that they're undervalued. But again, I don't look at the fundamentals because I've found they actually don't help you time bull markets or tops or anything like that. But we're definitely seeing a big influx of people moving in. If we look at it like silver miner juniors, the SILJ ETF, again, it's got into this parabolic phase. People are really piling into it. Look at the volume, the amount of people now moving into the most volatile kind of in the precious metal space. This is kind of screaming kind of herd mentality, and people want to make as much as they can and they feel like they're missing out. So this to me is a red flag. Again, this doesn't mean it's topping out right now. I think we could still see the markets want to shoot higher for that big final push, but you just need to be aware. Typically after a big straight up move with massive volume, that is the signature of FOMO, of kind of a bubble phase, of euphoric, where once it does lose steam, it might come straight back down temporarily and regroup for a while. So that's I like gold, physical gold, simply because I think it can hold up and move higher without the volatility. But obviously, if you want more risk, the mining space I think has some potential to do very well still over the next couple of months.
Incredible insights here on the volume that we're seeing for this specific ETF. A counter argument one might have is that back around, for example, 2016, ETFs were less popular and people might have moved directly into the juniors themselves rather than invest through an ETF like that. Do you think it holds up?
I still see it. I still see it as the same. I think, if you go back in time and you go look at the junior miners' individual volumes, you'd realize they've all spiked. So instead of a lot of people just jumping into individual miners and having to look at each one volume go up, the ETFs definitely are more popular now. They're an easy way to get a general barometer of what investors are doing. So I still see it the same way. There's no doubt. I mean, I remember back in 2008. I mean, that was the 2008 bottom in gold and miners. That was a life-changing move. It feels like a lifetime ago. Playing gold miners back then that were going up hundreds or thousands of percent up into 2011. It was pretty exciting, but we all traded individual stocks back then. I didn't really trade ETFs. I was focused on individual miners. Now, as you mentioned, a lot of people play the ETFs, but it's still the same scenario. You just have to know where to look. And the ETFs are a perfect gauge. What the ETF is doing for volume is almost the same as what's going on in the individual share volumes as well. So it's just an easy snapshot to get a high-level view of the space.
Well understood. Chris, I would love to hear what your framework is telling us for copper.
If you take a look at copper, obviously it had some pretty big spike and sell-off recently with all the tariff stuff. If we go back and look at the big picture, we're kind of seeing copper, running through these levels, this upper channel. Every time it seems to get up into this area, it does get met with some pretty good resistance and selling. It's pushing back up into this kind of nosebleed, this upper level on the monthly chart. If we drop down to the daily chart, we can get a view of the short-term price action. Now here we had tariff news that created a big pop, and we kind of had more news that created the big drop. And what it's doing now is just kind of backfilling in this giant price action, is drifting higher. I'm not a huge fan of copper. I think, yes, it's in an uptrend. It's had a very nice run percentage-wise, but overall, I do think it's a good barometer of the economy. And I think you're better to go off into more so precious metals like gold specifically than into copper. But I mean, the chart is in an uptrend. I mean, I don't have a whole lot of insight in copper. I haven't traded copper in forever. So it's doing the same thing as gold. It's pulled back. We are seeing copper, and we're actually seeing uranium stocks and copper miners. They've actually bottomed out and they're starting to move higher versus gold, silver, and miners they're still struggling. And I think they're a little bit of a leading indicator of, I think, what's going to happen with gold and silver. So I think there was a little bit of too much excitement in the precious metal space. It sold off and it's still under a little bit of pressure. Whereas copper and the uranium stocks and things like that, they quickly had a quick reset, and they're already starting to drift and push higher. And I think we're going to see that with gold. It's just, I think the uranium space and the copper space is a little bit smaller, and so it can react quicker. And it wasn't quite as much of a FOMO play. Precious metals is still working through a lot of people panicking and worrying if gold's going to continue this drop.
Really interesting to hear, Chris. And it sounds like you're looking at the commodity complex as a whole, as a peloton that moves together with winners and losers on the short term.
Mm-hmm. Yeah, the commodity play is pretty closely related, at least when it comes to metals. You got platinum, palladium, copper, and all of this stuff. It's kind of all the same thing. I believe they move together.
Excellent. And I would love to hear your take on oil and gas for a second. I've been hearing a lot of buzz. For example, spoke to Rick Rule recently, who's surely finding a lot of value in oil producers. What do you think the technicals are telling us for crude oil?
Yeah, when we look at crude oil, it's clearly in a downtrend. Overall, it just continues to fizzle and fade out. I think the energy stocks have been holding up very well. They've been kind of doing the opposite. Almost if we were to insert a symbol here and take a look at like XLE, for example, which is the energy sector ETF. If we were to just look at this and kind of split the screen, you can see, let me just zoom out a bit here. So we've seen oil move higher, and we saw energy stocks move higher. And then when we kind of see things start to mature, we actually start to see oil has been moving down. Yet energy stocks have still been moving sideways and slightly higher. And I think, oil has gone from $130 a barrel down to 60, yet energy stocks are still holding their value. So I think there's going to be a time where we see this is divergence. If these companies are potentially making less profit based on oil dropping down, eventually where it's going to catch up, and I think we're going to see the energy space have a big collapse and a big move. And I'm actually been watching and waiting for an opportunity to catch a move down in the energy space. We're not quite there yet, but we're very close. We have seen when we look at the energy space, it has kind of had this series of rising highs, and then we had this big crack to the downside. And now it's kind of moving back up into the middle resistance, into all of this resistance. And I do think eventually we're going to see this start to move over and sell off. I think when it comes to oil itself, I do think we're going to see oil break down, and I think we're going to see it head down towards the $46, $45 per barrel. It's had a recent bounce right off this low from earlier this year. If we look at this sweet spot, we've seen this bounce. And, each time it's gotten down here, we've seen a bounce. And I do think once it breaks that level, I think we're heading down to, $45, $46 an ounce, actually not an ounce, a barrel for oil. And I think that's also because the economy, there's going to be things showing the economy is probably going to be slowing. And that will also kick the energy stocks to have a big correction. So I'm bearish on oil. I'm bearish on the economy. And I think they're going to eventually move lower here.
Where does that price target of around $45 per barrel come from, Chris?
Well, if we look at price here, it's just move back a bit. So more or less, if we just look at this price action, the next key support level is going to probably be somewhere where it hit this level. So if we just kind of zoom in on the chart, depending on where we grab some of these levels, we can just look at this most recent sell-off. So there's a lot of noise on this chart, but overall, if we grab this sell-off phase and we draw to the downside of where that next move will be, just based on this most recent price action, it is showing it down to about $52. If we go back in time and look at some of these other ones, we've got these bigger patterns here that are unfolding. Now, we had this news-driven spike, which really kind of threw things out for a loop. This was, we had bombs getting dropped, and it created this huge move. And I've talked about this before, how I kind of scratch out that news-driven move. And if we were to just kind of use this more recent high, it brings us down to about $45. And this is one thing that a lot of people, I don't think, do, is sometimes you need to take some price spikes out of the charts if they're news-driven. If they just pop and take off and then reverse back down, it's not a move to be trusted. It's hard to use it in your calculations. I like to focus on the overall cycles of the market where it sold off and then it bounced up and rolled over, and it's going to work itself back down to the next target. So that's kind of how I came about it, just based on this leg to the downside, this bounce up, get rid of this news-driven, kind of bomb-driven spike that kind of just popped and faded really quickly. And that brings us down to this level. So that's where I get that.
Really interesting and very insightful, Chris. I would love to also talk about perhaps some other opportunities that you're currently finding that we haven't discussed thus far.
Yeah, I think one of them is actually going to be the U.S. dollar. Most people don't like the dollar. They think it's going to go down, but overall it has gone through a bearish phase. It has actually a signature bottoming type of price action happening here. It's actually turning a corner, and it's actually about to, I think, start another big rally. And if the dollar rallies here, that means the stock market is most likely going to start selling off in a big way. It will put some headwind for gold, but we have seen the dollar and gold move up together. We're in a sweet spot in the economic cycle, in the stock market cycle, where they can actually move up together, or gold can keep moving higher even if the dollar holds its value or moves up with it. So I like the dollar. I think the dollar is going to strengthen against other currencies. I'm Canadian. I think we're going to see the US dollar and Canadian dollar conversion really skyrocket. Right now it's about $1.40 exchange. I think we could actually see the dollar shoot higher, and the Canadian dollar, the loonie, drop in value. And we could see like $1.60, $1.70 exchange. So there's some pretty big upside play in holding the dollar index. There's an ETF for that if you want. If you're American, you're already holding US dollars, but you can take advantage of the dollar index with a dollar index ETF. As a Canadian, you can move your money from Canadian dollars into US dollars and try to play this move, this next potential rally in the dollar, which is a very safe play. In fact, if you go back in time and we look at, we go back and we look at 2022, and if we were to just put the stock market on here, if I just was to throw on, let's put the SPY, for example, in the bottom chart. Take a look what happened here in 2022. So the stock market on the bottom, the S&P 500, put it in the top, and it sold off 20+%. The US dollar on the top ended up rallying about 17%. So as boring as how much a currency might be, or how much people don't trust the dollar or the dollar index, it can be a very, very nice play. And what's really nice about the dollar is check out these pullbacks along the way. So we had a beautiful move, about a 3.5% move. Here we had about a 5% move. You have very low volatility. The biggest moves in the dollar are generally fairly small, like percentage-wise. You can stomach these. Whereas if you're holding the stock market, you've got these giant moves. Each time it sells off, your gut drops, and you're losing 10 to 20% on some of these plays, right? So the dollar is a great play. I like it. And I think it's coming to life. I think it's building a base. So to me, it's one of those hidden asset plays that we can take advantage of that most people never even look at. They're like, most people don't look at the dollar index as a trade, but it's a very steady opportunity with low volatility. And it goes up while everything else is going down.
And I guess if you're an internationally focused investor, there might also be an opportunity if the dollar index rises significantly while, for example, European stocks were to correct. You might have a double whammy where these effects compound on top of each other.
Yeah, the currency move, as soon as you're an international trader and you're trading US stocks, there's another level in there. At some point, you're like, there's a currency potentially countering the gains you're making if the currency's going the wrong way, or sometimes you get the benefit of both, right? So there are ways to navigate that in Toronto, or like the Toronto Stock Exchange. There's ETFs that allow us to play the S&P 500 and the NASDAQ ETFs, but they can be currency hedged. So if for some reason you think the US dollar is going to collapse in value, well, you just play the hedged ETF. So you're still catching the 10% move in the stock index, but you don't have to worry about what the currency does, because sometimes you can catch a 10% move in an index, but the US dollar drops 5%, and you actually only made 5% in the end because your currency value went down. So, as an international trader, you do have to kind of navigate and adjust some of those things during major phases. Right now, the sweet spot as a Canadian is to own equities or at least hold the US dollar at this point, because I believe it's about to start a rally.
Understood. Thank you so much, Chris. Please talk to us about technicaltraders.com.
Yeah, well, people can follow me at thetechnicaltraders.com. I share what I do is I manage my portfolio, and people can really just ride my coattails of the markets. If you go to thetechnicaltraders.com, I share the ETF trades I do. I use this asset revesting strategy, which is what I've been kind of touching on. We try to play 5 to 12 trades or waves that roll through the various assets, either stocks, bonds, currency, or cash. I do the occasional kind of discretionary bonus trade. We traded Bitcoin last year for about a 40% move to the upside. We just got out of a gold trade for a quick 15% move. So really, I just manage my portfolio, and I do a daily video each morning before the opening bell, and I share what happened yesterday, what's happened in overnight and pre-market today, what to expect, and we just navigate and manage our portfolios. I provide the signals, portfolio allocation per trade, the targets, the stops, pretty much everything you need to just navigate these markets, and you don't have to worry about what the Fed does, what the president does, or any of that. We just follow price and ride the waves.
Chris, thank you so much for your generosity with your time and your insights today. Really appreciate it.
Hey, thanks for having me. Pleasure to be here.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their SEDAR+ at www.sedarplus.ca.